Is seller financing the way to go? The numbers are in and they say yes. Stay tuned. Welcome to this week's edition of Note School TV, where every week we bring you the most amazing guests and the most amazing content. And this week, well, the guests are bringing the amazing content. So we'll get to them in just a second. Before we do that, make sure and like this episode. And if you have not already subscribed to the Note School TV channel, make sure and do that and hit the bell notification. Bing, yes, go ahead and hit that. And also, guys, this is an episode that you will want to share with your friends, your business associates, folks that you are looking at that may want to invest in notes, because this episode will tell the story of how the seller finance business is doing, and it is doing great, right? The water's fine. Come on in. So make sure and share this and learn it, study it so that you'll understand it. Guys, if you want to know more about what we do at Note School, simply go to noteschool.com/TV. Again, noteschool.com/TV. Now, it is my certain pleasure to introduce our founder of Note School, our chief visionary officer and all-around good guy, my friend, Mr. Eddie Speed.
Well, thank you, Joe. This is a very exciting episode because once a year, we have some industry friends that do a lot of research that discover the amount of inventory that's being created, essentially seller finance notes, right? And they are the best in the business at gathering this information. And we are very, very thrilled that they're on with us today. And they're going to guide us and show us through this inventory and how much is available. This really matters, guys. How many notes that are available is in direct correlation to our level of opportunity. And so today, our guest will do a great job of showing us how much that is. So with no further delay, I want to introduce you guys to my long friends, Fred Rewey and Tracy Rewey, investors.com. Those guys have done an incredible job of really gathering this information, and they are essentially friendly competitors in the business. So we're glad to have you guys.
Hey, Eddie, thanks for having us.
Thanks for
Yeah, with Steve, I've been at it since 1988, Fred since 1992. So we've known you all that time since we've been in the note business.
Yeah, it's been quite a journey, hasn't it?
It has, and it's our time. I mean, seller financing is always there, but it kind of goes up and down through the markets. And we're in a market where seller financing is hot, and we are excited to share some increases that we've seen over the last year.
Well, we're excited too, you know, as we all talk about behind the scenes like this, the level of inventory and the necessity for seller financing has really reached a peak in the business we haven't seen in, I'm going to say 10 years.
Yeah.
And so we're certainly fired up about it. And thank you guys. You guys, your give back to our industry as far as all of this research that you do to assemble this. It's very valuable. And so all of us from the industry, we're grateful for you guys doing that.
Yeah, that's Tracy. I just show up for the PowerPoint part, you know.
She's quite a detail worker. I know that from a long
Yeah, it's a lot of deck time of, well, what if we pull this number? How would we get this number? You know, so but it's fun. Yeah, it is a good time industry wise, and it's fun to do the numbers. And then every year we always come up with some additional dive a little bit deeper. And then as technology's gotten better over the years, we can, you know, get kind of hone in on those numbers more accurately. So, but there's a couple of really interesting things about last year that, you know, surprised what we had a sense of and what happens, you know, how well they lined up. But there were a couple real surprises.
Well, we got some slides, Eddie. Shall we show those? And you just interject, ask questions, tell us what you're seeing in the market on your side as well. So you've got a lot of intel as well. So we're excited to talk a little bit today about exactly what happened in 2023. And if you're thinking, hey, Tracy and Fred, April of 2024. That's because it actually takes that much time to get all of the data from the county courthouse records. And so this comes in, and then we crunch the numbers, and we're fortunate enough to work with Scott Arpan with Advanced Seller Data Services to get this kind of data. So this is some of the things that we're going to cover today.
Yeah, we're going to cover kind of some, the key seller financing trends. So what, we tend to look at the same trends over and over each year. So we're going to talk about the key ones that we look at.
We're going to talk about note amounts and loan to values.
We're going to break down note creation by property type.
And what 10 states make up almost nearly 70% of the volume.
Yep. We're going to talk about the mom and pop, sellers compared to pros. In other words, who's only creating one note and who might be in the business of creating notes.
And then what's happening now? Where's the opportunity?
Yeah.
So drum roll, how big is the owner finance market?
How big is the owner finance market, Tracy?
Well, in 2023, there were 28 billion with a B in seller finance notes created.
Yeah, so that's basically what we always track is the last 5 years. So we kind of do a trailing last five, if you will. So there's 125.5 billion in the last 5 years. Now, two things about that. One, and Eddie said earlier, how many notes being created to what's available. I would argue, by the way, that we always have more notes than we can buy. I mean, we've never even been close, but it's nice to see a robust industry that keeps growing on there. And the second thing about that number is, look, not 125 billion, not all of it's buyable. I mean, some of the stuff is notes that either are new that we have no interest in. Maybe they're rougher properties. Maybe they're, just not in a location we want. So I'm not saying 125.5 billion is buyable notes today, but some of them, when they get seasoning, some, whenever it may be, they could be. And I don't need all of them to be, quite frankly.
Yeah. And I think that it's important for people to realize that these are seller finance notes. That's just one segment of the market. So seller finance notes, it's when I own the property, I sell it, let's say to you, Eddie, and I allow you to make payments to me over time. And instead of you having to go out and get a bank loan. And so these are first positions. They could be wraps where maybe I bought subject to and sold and wrapped my underlying mortgage. They could be contract for deeds, provided that they're recorded, but it doesn't include regular contract for deeds that aren't recorded. It doesn't include all these private loans that are made, because it's specifically where the seller deeded the property and took back a mortgage or a deed of trust. And it doesn't include all the scratch and dent, non-performing stuff we see on the secondary market. So it's just
one. And they're all over 30,000.
And they're all over 30,000. Yeah. So
a very specific targeted list that you've got analytics on.
Mm-hmm.
Yes. Yeah.
But it's the bulk of what's out there, over 30,000, first position, Yeah.
So how does that compare to last year? That's what we all want to know, right?
Yeah.
Yeah. So this is the big one. We're going to talk about this in a second as break it down. But basically, year over year. So from 22 to 23, it was up from 22 billion. So up to 28. So it was a 24.2% increase in that category. So, in the notes.
Dollar volume.
Yeah, in the dollar volume. So that's huge. And you could say, well, yeah, obviously things got more expensive, but
there was also an increase in the count. So the number of these seller finance transactions was up 7.3%. So nearly 90,000 on the count. So we saw an increase in the number of seller finance deals and the dollar volume. Now that doesn't surprise you, does it, Eddie?
No, because I think what it means is people are seller financing more high dollar properties. And obviously, there's more people utilizing seller financing, but seller financing has become more utilized in all property classes, not just what we call the cheapos, right?
Mm-hmm.
Yeah. Yeah. And properties are going up. So we talk about what's behind the increase. And it's really interesting that we had an increase, because overall in 2023, the regular market, the existing homes that were sold, the National Association of Realtors said at the end of 2023 that it was down 18.7% from 2022. And they'd had the weakest existing home sales since 1995. And the year prior, in 22, it was also down. So we saw seller financing go down about the same rate in 22 from 21. But in 23, we saw it go up. So it's fun to talk about, why is that? Why did seller financing go up when existing home sales went down?
Void in the market?
That's exactly right.
Yeah. So one of the, I mean, it was surprising because we thought it'd be up, but I mean, it was up substantially. But one of the things is that we're starting to see the settling, the effect of the credit mortgage availability index, which this basically, for anybody that's not familiar with it, this is the index of basically how hard is it to get a loan. You can see various drop-offs of, you know, when it got easier, and the higher the graph gets, the easier it is to get a loan. So you can see, you know, back around 2012, it was right around that 100 mark, and you can see that it climbs over the years, and it got easier and easier and easier to get a loan. And then there's the big drop-off you can see during the pandemic when everybody just kind of tightened up. And ever since then, it's got tougher and tougher to get a loan. And what's interesting about this is that everybody always says, well, you know, money's only 4% or 3% for a mortgage or 4.5%. If you didn't qualify for a mortgage at 5.5%, 6%, you probably still didn't qualify at 4%. Yeah, your payment might have been lower. Maybe that was what, you know, put your ratios just over the edge to qualify, but it's tougher to get money. And as it becomes tougher and tougher to get money, it's, you know, people have to go to other methods in here. And our industry tends to trail this a little bit. There's a little bit of a lag.
Yeah, so when it's harder to get a loan for a conventional bank because they want more money down or they want a higher credit score, or rates are going up, and so somebody's payment goes up and it affects their debt to income ratios, that and what's going on in the secondary market where they're not buying as much of these government-backed loans, we're seeing it's harder for people to get a loan to buy a home. When it's harder to get a loan to buy a home, there's more seller financing. And as Fred mentioned, we can see that. The last time we saw a big increase in seller financing was after the subprime mortgage meltdown. And now we're starting to see seller financing creep back up in this current market.
Yeah, the feeling in the marketplace, guys, I think that we're hearing is, you know, there's a lot more real estate investors, you know, that are trying to create notes. And I know you've got stats on that, so I'll be interested to see, you know, what the real impact of it is. But I think we'll see a growth in seller financing this year as well, even though, you know, I mean, credit is not looser. Mortgage rates are really not cheaper. And by the way, they're going to sell more houses this year than they did last year. At least that's what the trend looks like so far.
Mm-hmm.
Yeah, they should pick that back up. Yes,
yeah.
That's what everybody's expecting. So we love to look at owner financing is not just on residential. So what types of property have owner financing?
Yeah, the breakdown of this is typically about the same every year. So roughly 50% of the notes that we're tracking in here are residential. It's $14 billion. If you go by dollar amount, it represents roughly 63% of the count, which is 56,352.
And then commercial is the next largest piece. It's 9.3 billion, or about 33% of the dollar and 17% of the count.
Yeah, land is the next one, 3.8 billion, 13% of the overall percentage, 14.418 percentage of the count.
So 16%.
And then we just
of the
kind
count,
of have another, and then we just have kind of an other category where this is stuff that we just can't quite track, which gets smaller and smaller every year.
Yeah, and it pretty much is the same ratios as the split up as residential, commercial, and land. So yeah, you can see residential is the big bulk, then commercial, and then land. So we have a little bit of everything in the seller financed world. What's interesting though, when you look at this 5 years trailing, this 125.5 billion, we can see that residential in the dollars went up about 17%. It went from 11.9 in 2022 to 14 billion in 2023. But wow, look at that commercial. Yeah. It went from 5.8 to 9.2. So commercial's really making a move in the seller finance area.
Not surprising with the commercial lending market environment being what it is.
Right.
Yeah, very true. And we expect to see that number continue. Now, land just sort of held the same. Land got really active back in 2019 and 2020, and then it kind of dropped off to its normal levels after that. But we can see when you add all those categories up, that's how we get to that $28 billion.
That's cool. Great information.
So this is a fun category. This is something we always look at the average amount and what the loan to value. And I love this first box because there's always this perception in our industry of, oh, notes are created by no money down and bad credit or 2% down and stuff like that. And that's just not what the data shows that we're able to see, that we're able to track. Basically, of the residential, the average note is $248,523. which is roughly a 10% increase. And the loan to value on the properties is roughly 74%. It went down versus 75, but I don't think that's a consequential move by any means. But, you know, a lot of equity in these properties when the perception is the whole no money down or whatever everybody thinks our note industry is.
So this means that on average, a seller finance deal had almost 26% down. Well, let's call it 25% down. Now, this is based on states that actually report the public data, what the sales price was. So if a state doesn't report that, they can't get included in here. But we feel like it's a pretty good sampling to say that's the average overall. Does that surprise you, Eddie? Because I know you tell people, let's try to get some more money down on those.
You know, well, we have a trade desk and we buy seller finance notes from a fairly substantial broker network. And so this tracks with the data that we're seeing, including the data, Fred, that you were talking about with commercial real estate. We're seeing a huge increase in commercial loans that are coming across our trade desk. So it's on the rise.
It is.
Down payments, big down payments are awesome.
Yeah, we love big down payments. We like it to be occupied too with commercial.
And,
right?
I think this is a testament to what everybody touched on earlier, is that, you know, when we go back to the credit, you know, there's a lot of reasons you don't get a bank loan. I mean, they have a series of check boxes, and you know, down payment is just one of those check boxes. If you're self-employed less than a year or 2 years, you know, just recently moved, there's a whole lot of reasons you don't pass that. So it isn't necessarily that people don't have down payment money is stopping them to getting those bank loans.
And then we go and look at commercial, and it might surprise people that loan to values are also low on commercial. The average loan to value is 72% on the seller financed commercial note. Its average note size is much larger, $613,000 compared to about $432,000 the year prior. So that was actually a 41% increase on the average note amount for commercial. So that is, we're seeing much larger commercial on there as well.
Yeah.
Yeah, and land stays roughly in the same kind of category. It went up slightly, a 6.5% increase, which I don't think that's anything necessarily measurable. The loan to value went up from 68 to 70, which is 30% equity. Again, pretty much in the ballpark. So I'd say land stays pretty steady year over year, 22 to 23.
And it's interesting because, you know, we always tell people that if anything less than 10% down, you have a very high risk note, because they don't have much skin in the game, the buyer, the borrower. They're much more likely to default, or if they do default, they don't have very much equity to protect, or they don't have very many options. So the more down payment, you know, we love to see these notes created with 20% more down payment, or sometimes the seller will push a piece of that into a second, like the old 80-10-10s, you know, the 10% down, 10% second, and 80% loan. So those are a couple of different options, but we can see people are definitely using those when they're creating notes. This is so fun. This has been true for all the time we've been tracking this, but there are the top 10 states that usually create between 67 and 70% of the volume. And then the other 40 states make up the other 33%. People always want to know, hey, what states do the most volume? So we've got to give a nod to your state of Texas, Eddie. Number one, again, as it is all the time.
Yeah. And what's interesting about this is that we go by count, not by dollar amount. So it's not skewed by, you know, because you would think by looking at this map, just on the ones that are colored out of the gate, is that, well, these must be more expensive properties, you know, coastal states. But we go by a count. So this is physical number of deals, not the dollar amount associated with these deals. And Texas is number one with 25% of the overall creation. It's a big state, and it creates a lot of notes.
You know what I've learned, guys, is there's something to real estate investing that it's kind of a copycat system. If it becomes a common practice in certain geographic areas, then a lot more people will do it. And as you guys know, because when you work for the big institutions and you've subsequently been in your own note buying operation for many years, there's just a lot of Texas notes. And that's because it's just a common line of thinking here. And as I think the evaporation of credit and the long-standing higher interest rates, I think we'll see other states that are going to see the value like Texas does.
Mm-hmm. I think you're right. And you guys have a lot of good laws that protect both the lenders, the sellers, and the buyer, the borrowers. And so I think we'll see some of those, especially when it comes to wraps. I think we'll see more of those trickle into other states as well. So Florida was number 2, and then followed by California. And then we've got North Carolina and Georgia. And then we sprinkle in another 5 states. And we can see that we've got the rest of the numbers that travel.
Yeah, 6 is Arizona, 7's Washington, 8's New York, 9's Pennsylvania, and 10 is Oregon. Yeah. So you know, you could it's interesting. They hug the coast. You know, I mean, they tend to be more areas they're doing different things. I think we always think that North Carolina is and Georgia are just odd ones in there, but they have the numbers. The next thing we're going to do is try and figure these out per capita. That was the one thing we were talking about that we've never drilled down.
Yeah, that would be fun to do. Yeah. So all 50 states have seller financing. It's not just those top 10. And so if anybody wanted to see the whole list of states, they're welcome to visit our website at noteinvestor.com/stats, and they can download a copy of the report, including all 50 states there as well. This leads us to the type of note creators. Very excited about talking about the difference between mom and pop sellers who create just 1 note in 12 months, and then what we call seller financing pros that do 2 or more in a year.
Yeah, so the mom and pop is what we all know and love. I mean, it's basically someone sold a property, retired, moved to another state, sold up in Michigan, moved to Florida, sold in California, moved to Arizona, whatever it may be. These are mom and pops. They probably sold their personal residence and moved to another one. And they are still the lion's share and probably, always will be. They're 86% of the notes. And this is created in a 12-month period. So there's 1 note created in a 12-month period. But then we further break it down to people that have 2 or more notes.
So that makes up 14%. So the 86 and the 14 make up 100. And then out of that 14, or 8% of the whole created 2 to 3 notes, and 6% of the whole created 4 or more notes. So we've got people that are out there professionally creating a good number of these notes, hopefully doing all the things they know to do to underwrite, make sure that buyer borrower has the ability to repay, looking to see if they need to comply with Dodd-Frank, all these different things to make good quality paper that people like us can go out and buy.
Yeah.
One thing, Eddie, and you kind of led to it in the beginning, but interestingly enough, and it would have been what we've thought, the pro category, which is 2 or more, hasn't really grown. It's been the same percentage of the overall for as many years as we've tracked it. And we always had the sense that that was an area that would be growing, but I don't think it can one guy doing 3 notes instead of 0 doesn't make up for the mom and pops, to your point about, as the word gets out going, this is a common way to do it. And also, as people start to realize, well, wait a minute, I can sell my home. I don't need all the money. I can defer, capital gains or whatever on it. I can get 8, 9, 10% on my money while I do it. I mean, I think people are starting to realize this is a very viable strategy for part of their retirement, especially if they don't need the money right out of the gate.
We're frequently asked kind of on the real estate investor side, this creative financing. People say, people look at rental properties and they say they're all the tax advantages. Everything about rental properties are the tax advantage, kind of like you're being punished if you own or finance. And so what we've tried to do is kind of up our game as far as understanding what the tax hacks are for seller financing. And there's really a lot. I mean, it's possible that you can defer. We know you can defer your capital gains with installment sales, but it's even possible that based on your income that you literally, there's a ceiling before capital gains tax is triggered, depending on what your income is. And it's very reasonable to assume that if you could take your money out over time in capital gains and literally never be taxed on it. That's really a tax hack. Right.
Yeah.
And, I always tell people, okay, if you love real estate outside the retirement accounts for depreciation, then do your notes inside a retirement account where it's tax-free or tax-deferred, depending on if it's a Roth or a traditional. Yeah. So, yeah, lots of opportunities out there.
This is such good information, guys.
Well, and this we started tracking last year. Scott was able to pull this. We wanted to know, how are these seller financiers taking title? So 57% of the whole took title as an individual. So it's not that whole 86%. So some of the mom and pops that are just doing 1 in 12 months are using an entity.
Yeah, so there's 32% are an entity, and then the remainder becomes trusts. Don't really know what to do with that information other than, for me, I mean, one of the greatest referral sources, or one of the greatest ways to do business in the note industry is referral sources. You get to know somebody that can refer you more than one deal. If I have any takeaway personally from this graph, I'm like, okay, you've got 32% corporate and 11% trusts. Someone had to set up those entities for them. Someone was somewhere, an attorney, somebody had to set that. I don't think they all went online to, set up my own corporation.com or whatever it is out there. So to me, those are people that could refer people to me. Other than that, I'm not sure what to do with that information. I find it interesting. It's more of a sophisticated seller when you look at only 57%, and that doesn't make them unsophisticated. It just means that there's only 57% are actually not in an entity of some sort.
Yeah, and the trusts, I think, have a lot to play with how many self-directed IRAs. All those are taking title as a trust as well. So I think all of that plays into seeing.
And a lot of family protection, inheritance type stuff.
Yep. So what's happening in 2024? Get out that crystal ball.
This is the part where it's an advantage that we can't physically get all these numbers to this because we're already done like 3 months out of the year. So we are actually, it's a little easier to guess. But I mean, first thing, obviously interest rates aren't going anywhere. We've talked about this, the Fed's indicating lowering. The Fed could lower the whole point, which they won't in one shot. But even if they lower the whole point, that doesn't mean everybody can go out and run and get a mortgage at a full point less. It's not going to go down, point for point. They're not going to go back down to 3% loan. If you're sitting out there waiting to do your mortgage, you're like, oh, I want to get 3% money. Not going to happen again. They never should have let it get that low in the first place. Inflation,
We see there's different things happening in different markets. It's interesting that there's a low real estate inventory. So that low inventory is what's keeping pricing for housing up, even though interest rates are going up. And so in some markets, we're seeing a softening, but not in all markets. So that's very regional. As you mentioned earlier, Eddie, we're starting to see more inventory for home sales come on the market in a lot of places. But what's going on out there, we've got banking, commercial challenges, politics, global uncertainty, all this combined with what you were talking about earlier.
Look, banks right now, we are a derivative or a sidebar to when people need alternate forms of financing. And I don't think the banking thing's going anywhere right now. As a matter of fact, if anything, I said it on an interview last week. I said, they're sandbagging. They're really concerned. A lot of them got, the banks, the music stopped and they were without a chair and they're trying to figure out what to do. And they're afraid and they're gun shy right now. They've got money on the books a lot lower than they want it. And they don't want to get stuck in, the market turning. So they're going to be very, very careful going forward, which is great for us. And I think that's another indication why last year was so good for us.
Well, we're looking at the banking industry. We're looking at about 30% of all the commercial loans. So here's a couple of stats, right? The big banks, the top 25 banks, only about 14% of their portfolio are commercial loans, but 44% of the rest of the banks, their whole book of business, in all of their assets, 44% of them are commercial loans. I think it's 31 or 32% of those loans are due for a reset in the next 18 months.
Yeah.
So banks are clearly the banks other than the top 25 banks are not going to be aggressively lending. And so I think, guys, that we're going to see a very substantial increase in seller financing on commercial property, which obviously you noted this year. And the price band, as you guys noted, really hopped up. I see those are the reasons, that it would be even more. So, guys, this is such great information. And the great news is you're willing to share it with everybody. Thank you for that.
Yeah.
Absolutely.
Yeah. They have the chart. And if they go to noteinvestor.com/stats, you can download copies of all the data and all the remaining states that we didn't mention exactly how many are created in those states.
And people say, why do you share all this data? I'm like, well, there's 28 billion. I can't buy all 28 billion. So there's plenty to go around. And so, you can buy notes in your own backyard. You can buy notes in another state. Much easier to own a note in another state than to own a rental property in another state. But it's a lot of great information. Seller financing has been good to us. And it's how we met. It's how we got in. It's how we kept our family supported for 30 years. I know, same for you, Eddie. And so we're excited to share the information, because our goal is that if people get knowledge, they'll create notes that are good for the sellers, they're good for the buyers, and they're good for the investors. Everybody truly can have a win-win-win situation. And we've got a lot of opportunity right now, if done correctly, to create wraps, where we wrap those underlying lower mortgage rates at these higher rates. I know you do a lot of work with those too, Eddie. I know with Jeff Watson, and we're through the Seller Finance Coalition. We're just trying to make sure people are knowledgeable in what's happening out there, and they think, it can't be done, but you can get a good down payment. You can make sure your borrower has the ability to repay and still make good notes that you can buy.
Well, for the Seller Finance Coalition guys, we want to thank you guys a lot, because you really helped us immensely with a fundraiser earlier this year, and your involvement in, I think we're all trying to make seller financing better. And thank you guys for what you've done there. I mean, we really wouldn't have been able to pull off our Seller Finance Coalition event. It had not been for you guys. And so I think not only are the numbers looking better for seller financing, but I'm generally seeing a better grade of seller financing, right? So people are getting better at creating good notes.
I'm seeing some better, and I want that trend to continue. And then I'll have somebody bring me a note where, they've got an underlying, they're all excited that was 4 and they wrapped it at 5. Or I see, and they created a note last year and they wrote it at 4. And I'm like, okay, people, you can go out, stick your money in a CD at 5 with no risk. Banks are lending at 6.5, 7. You should not be writing your seller finance notes at 4 right now. That's okay if it's from 5 years ago and that's what rates were, but not today. Not today, people.
I kind of laugh and say that you can kind of tell who the sharpest trader was, the buyer or the seller,
right?
By looking at the terms.
Well, sure, it's great if you're the buyer. I know about it. Yeah.
Look, we've all three of us in this industry for over 3 decades, each. So I mean, we've all seen the ebb and flow of all and stuff and I've always thought, if you are selling a property and carrying back a note, your starting point is 10%. Now, I mean, just your average, this is the starting point. Now, big down payment, yeah, let's go ahead and make it 9, 8.5. When rates got all the way down to 3, I could see giving up on that. I can say, okay, you know what? I'll come down a little bit. I'll be at 7. I probably wouldn't have gone below 7, because but people feel like they can't do that. Like they got to be competitive with bank. We don't have to be competitive with bank. Dude, if you don't want to pay 7, 8, 9% on a note, then go get finance. Go get your money someplace else. If I'm charging too much, if this is what it costs to do with me, and how important, I don't think people realize how important that is. They think they're going to carry back that note, but we all know what happens within a couple of years. Something changes and they want to tap into that money, and that's okay. But the lower they write that note, it's just so hard to the person that they thinks they structured it well, and they write a 4% note or a 5% note, and it's 30 years, and you do the math and put it in the calculator, and you're like, this is the discount. I mean, that's just math. It's not me. I'd love to give you 100 cents on the dollar, but I can go right now on E-Trade and get 5.2% on a CD. Why would I buy your note at 6 or 7 or even 8 when I have a guaranteed in the bank CD?
Well, 1/3 of all loan originations are non-QM loans. And those rates today, the bottom of that market, the bottom rate is about 9.5%.
Yeah.
So it's tracking, Fred, with what you're saying, that this is not Fannie Mae paper. It's not that it's bad, right? Yeah. But by the way, you've seen how tight the credit underwriting is for Fannie and Freddie, right? You guys showed that chart. So it just because they can't qualify for a Fannie Freddie loan doesn't mean they're not qualified.
Yeah.
And doesn't mean that can't be a good borrower. So we'll be sure and put you guys all your information in there for Note Investor, and all the stats in there, or how to go get the stats and any other information in the things. Once again, thank you guys so much for really just a wonderful presentation, super detailed. I'm not surprised that you guys have such a great detailed presentation, because I know you so well. I know that's the level you play, but great give back to the industry. And we're all grateful for you guys for really helping us feel like we're working with a map, right? We're not just blindly finding our way through the business, but we're actually statistically guiding ourselves through the business. So thank you guys very much. You're awesome. Great to see you. And Joe, we're going to let you have it back, my friend.
Guys, another great episode. And Tracy, Fred, thank you so much for putting this together. I know you guys spend hours upon hours of compiling this data every year. You do it tirelessly, and it is, it is an amazing thing for the industry to have folks like you that are doing this. So again, thanks so much for doing it. And want to know more about Note School and what we do, just go to noteschool.com/TV. And we would love to get you into one of our master classes coming up real soon. Thanks, and have a great week.